Welcome back to the Deep Dive. Today, we're ripping apart some pretty complex research protocols and some really dense financial reports.
We are, and we're taking what I call a high conviction journey into one of the most intriguing companies in the digital asset space.
A really aggressive play. We're talking about Bitmine Immersion Technologies. The ticker is BMNR.
And the timing on this, I mean, it's just absolutely critical. We're analyzing BMNR right now, trading at what, $31.91, and it's December 3rd, 2025.
Which is a huge day for the Ethereum network. The Fusaka upgrade is going live as we speak.
Exactly. And that matters because this company, it's long past being just a simple miner. It has transformed into this massive multi-billion-dollar treasury vehicle.
With this just staggering strategic goal, controlling 5% of all circulating Ethereum supply.
5%. The alchemy of 5%. That's what management calls it. It's a huge, huge goal.
So our mission today is to filter this, this incredibly volatile high-tech story through a more traditional lens. Can we even apply Warren Buffett's principles here?
That's the question. Looking at durability, capital allocation, and, most importantly, margin of safety, but in a crypto context.
And that brings us to the central paradox we found, the big tease for today. The stock is trading at near parity to its underlying asset value.
That's right, near parity. We're talking about a 1.01x net asset value, or NAV. It's astounding.
Let me just make sure I'm hearing that right for you listening. The market is pricing this stock at almost the exact value of the assets it's holding right now.
That's it. Think about what that means. If you buy BMNR today, you are, for all intents and purposes, buying $1 worth of Ethereum for $1.
So the entire future growth model is just free.
It's being offered for free. The potential for a MicroStrategy like premium, the hundreds of millions in potential staking revenue, the whole strategic plan, none of it is priced in.
And unpacking why that is, why the market is so skeptical, that's the critical takeaway we're going to explore.
Let's get into it.
Part 1, chapters 1 to 3, business, management, and financials.
Chapter 1, business understanding.
Okay, so to really get BMNR, you first have to stop thinking of it as just a mining company. It's much more complicated than that.
It really is. It's a hybridized entity. You can almost see it as three distinct businesses all operating under one roof, under that one ticker.
And that hybrid nature is where all the strength, but also all the confusion comes from. So we've got Pillar 1, the huge passive treasury.
That's where most of the value is. The vast majority of its $12 billion enterprise value.
Then Pillar 2, the legacy mining operation, which is still important.
Very important. It's the engine. And then Pillar 3, which is the really exciting part, the budding financial services arm.
Let's start with Pillar 1 then, the treasury strategy. They're calling it the Ethereum standard.
And the scale here is it's hard to wrap your head around. A BMNR holds approximately 3.73 million ETH tokens.
Which makes them the largest publicly traded holder of Ethereum in the world.
In the world. They control over 3% of the total supply. It's a massive position.
So at current prices, ETH hovering between $3,000 and $3,200, what does that translate to in dollar terms?
You're looking at a gross value of somewhere between $11 and $12 billion. Just locked up in that treasury.
So this asset pool isn't just part of the company?
It is the company. The stock price follows the price of ETH, almost 1-to-1.
So how does management, specifically Tom Lee, justify this extreme concentration?
They have a very strong, and I'd say contrarian thesis. They don't see ETH as just another crypto. To them, it's digital oil.
Digital oil. Meaning it's the fuel for the whole system.
Exactly. It's the fuel for DeFi, for NFTs, for the whole tokenization economy. They believe it's essential infrastructure.
And the strategy for hoarding so much of this digital oil is what?
It's a classic supply shock mechanic. By buying up and holding such a huge chunk of the supply, a supply that's already becoming deflationary, by the way, they're trying to create a squeeze.
So if network usage explodes like they think it will?
Then the demand for that limited supply should, in theory, drive the price up disproportionately. They're just maximizing their exposure to that curve.
Now, they're not 100% ETH. The research shows some diversification, right?
A little. They have about 192 Bitcoin, probably left over from their earlier mining days. And, more interestingly, a $36 million equity stake in a company called 8Co Holdings.
The moonshot portfolio, as they call it.
Right, their little internal venture capital arm. We'll get back to that when we talk about management.
Okay, let's pivot to Pillar 2 then, the industrial mining business. It's small in comparison, but it provides some key advantages.
Some really important moats. The first one is right there in the name, immersion technology.
This is a physics-based advantage, not just a financial one. Explain how that works.
Well, instead of using giant, power-hungry fans to cool their miners, they submerge the hardware, the ASICs, into big vats of a non-conductive fluid.
A dielectric fluid, like a giant bathtub for servers.
Exactly. And the physics of it, the thermodynamics, are just way more efficient. The fluid pulls heat away so effectively that they can safely overclock the miners.
So they run them hotter, faster.
And harder. They get 25 to 30% more hash rate, more computing power than their air-cooled competitors. That translates directly to more revenue per machine.
And then there's the second moat, which might be even more important, the Trinidad power moat.
This is a massive structural advantage. They locked in a long-term power agreement in Trinidad for an incredibly low price, 3.5 cents per kilowatt hour.
And just for context, what's the average industrial rate in the U.S.?
Oh, it can be anywhere from 6 to 8 cents, sometimes even higher. So BMNR's Trinidad operation is getting a 50, maybe 60% discount on its single biggest cost.
That's an unbelievable advantage. It guarantees that mining engine stays profitable even when prices are low.
It ensures cash flow resilience.
Right.
And while they do have U.S. operations in Texas and Pecos and Silverton, those face much higher U.S. power costs. Trinidad is the key.
Which brings us to Pillar 3, the financial services arm, the Maven initiative.
And this is the real pivot. This is what could transform BMNR from just a passive holding company into an active, yield-generating machine.
Because you can't just let $11 billion of an asset sit there doing nothing, right? Especially an asset like ETH.
Not when the underlying technology has a built-in yield mechanism. Maven stands for Made in America Validator Network.
And the launch is slated for Q1 2026. So what does this actually mean for the company?
It means they're going to put their treasury to work. They'll use their 3.73 million ETH to help secure the network, to become validators, and in return, they'll earn staking rewards.
A staking yield. So what kind of revenue are we talking about?
Well, if the network pays a pretty conservative 3 to 4% annual yield, you're looking at potentially hundreds of millions of dollars in new, high-margin recurring revenue.
And that completely changes the story. It's not just a volatile asset shell anymore. It's a potential cash flow machine.
Which brings us right back to what's happening today. The Fusaka upgrade. This isn't just some tech jargon. It's fundamental to their entire business.
So let's break it down. What is PureDAS, and why does it matter so much to BMNR?
Okay, so Fusaka is all about solving Ethereum's scaling problem. PureDAS, or Peer Data Availability Sampling, is a new way for Layer 2s, the networks built on top of Ethereum, to process data more efficiently.
So it's like creating fast lanes for data on the highway.
That's a great way to put it. It makes transactions on those Layer 2s faster and cheaper. And if the network becomes more useful, more people use it.
The demand for the underlying ETH token goes up. It boosts the value of their entire treasury.
Exactly. But it also has a direct benefit for Maven. It actually lowers the hardware and data costs of being a validator, making their Q1 launch even more profitable from day one.
So when you look at the whole competitive landscape, it's pretty clear what they're doing.
They are explicitly positioning themselves as the MicroStrategy of Ethereum.
No question.
Yeah.
MSTR has the Bitcoin crown. BMNR wants the Ethereum crown.
And that sheer size, holding over 3% of the total supply, creates what we'd call the whale wallet mode. They are just too big to ignore.
It gives them influence, doesn't it? On governance, on getting better terms from institutions.
Absolutely. And you can't overlook the regulatory mode either.
Right.
Just successfully becoming a public company, navigating the SEC while holding billions in crypto, that's a huge barrier to entry for any competitor.
They've already done the hard work of paving that road.
A very hard road. Any new company trying to do this would be years behind on legal and compliance.
Chapter 2. Management evaluation.
All right, so we've talked about the assets, the hardware. Let's talk about the people, the human capital behind this whole strategy.
And what's so interesting here is this blend. You have this old school finance pedigree mixed with some really aggressive crypto conviction.
And the architect of all of this is the chairman, Tom Lee. You can't talk about BMNR's strategy without talking about him.
His background is from Fundstrat, right? Deep equity research.
For decades. He's known for making these big, contrarian, data-driven bets that go against the market, and this is his biggest one yet.
And his bet is that ETH isn't just an asset, it's a future yield-bearing bedrock of the new economy.
He's all in on that thesis, and one thing that really builds confidence is his transparency. Remember that dip back in October?
Yeah, he was very public about their buying activity.
He came right out and announced they had stepped up their purchases by 39%. That tells shareholders we're using this weakness to get stronger. That's huge.
That is huge. And the recent change at the top, the CEO transition, also tells a story.
It does. Jonathan Bates, the old CEO, he was the infrastructure guy. He built the mines.
And now Ji Tang is in.
And Sang is the asset manager. His job isn't to build more physical stuff. It's to make that multi-billion-dollar treasury generate yield and to connect the company to traditional capital markets. It's a maturation story.
Right, from industrial to financial services. We also saw some notes about their advisors, like Jonathan Teo.
Yes, from Binary Capital. He has a background in scaling consumer tech and network effects, which fits perfectly with where they want to take Maven. It's all about mass adoption.
Okay, so let's get to the real test of management. Capital allocation. How are they using their money?
Well, their primary method is designed for one thing and one thing only: maximum exposure. They use at-the-market offerings, or ATMs.
So they're selling new shares directly into the market to raise cash.
And then immediately sweeping that cash into buying more ETH. It's a constant cycle.
Which sounds like a speculative carry trade. And this is where I want to push back a bit. The shareholder dilution has been insane, right? A 19,000% increase in shares outstanding.
Staggering.
So how can they justify that? Isn't that just destroying shareholder value, even if the asset is going up?
That's the core critique, and you're right to raise it. The only way this strategy is rational, the only way it works, is if the return they get from ETH appreciation is massively higher than the cost of that equity they're issuing.
So they're betting the crypto supercycle will be so powerful it'll just dwarf the dilution.
That's the bet. If they're right, everyone wins big. If they're wrong, it unravels very, very quickly. It's all about conviction in the asset price.
Okay, what about returning cash, that symbolic dividend, 1 cent per share?
Right. The yield is tiny. It's basically nothing, 0.03%. But the signal is profound.
What's the signal?
The signal is we are not just a speculative shell company anymore. We are a business that intends to generate cash flow and return it to shareholders. It sets the stage for Maven to become a real dividend engine.
It differentiates them.
Yeah.
Okay, but then you contrast that with the share buyback program. A tiny $250,000.
On a $12 billion company, it's purely for show. It's symbolic, not substantive.
Because the stock isn't trading at a deep discount, so they don't see it as a good use of capital.
Exactly. A real Buffett-style buyback would happen if the stock was at, say, 0.5x NAV. They're not there.
And lastly, that $36 million stake in 8Co just feels like a distraction.
It feels like a distraction. It introduces execution risk that they just don't need. When your whole story is a pure play on Ethereum, why are you suddenly running a small VC fund on the side?
Investors aren't buying BMNR for venture exposure. They're buying it for ETH exposure.
And it risks diverting management's focus from the core multi-billion-dollar prize. It's a sign of complexity creep we have to watch.
A really important distinction. Hey, if you're finding this deep dive valuable, let us know.
Like and subscribe to Stock Analytics AI.
For the deepest data and analysis, you can join our community.
For $4.99 month, get 500+ deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next. Plus, members-only requested deep dives.
Chapter 3, Financial Health.
Okay, when you first open up BMNR's financial statements, you hit a brick wall, and that wall is JAP accounting distortion.
You just can't take the headline numbers, like net income or PE, at face value. Let's break that down for everyone. Why does standard accounting just fail with crypto treasuries?
The main problem is how digital assets are classified. Under GAAP, they're indefinite-lived intangible assets. This means if the price of ETH falls below what BMNR paid for it, they have to take an immediate impairment loss.
Which hits their net income hard.
But, and this is the key, if the price of ETH goes up, they can't record any of that gain until they actually sell the asset.
So they can only report losses but not gains?
Yeah.
That's a huge distortion.
It creates these wild paper earnings. The reports show a net income of $348 million and an EPS of $13.39, but that's not from operations. That's from unrealized crypto movements. Their actual owner earnings from mining are negative.
And the scale of this is just crazy. When you look at it, you have a $12.26 billion market cap.
But only $6 million in actual operational revenue last year. $6.095 million to be exact.
The mining business is just a tiny speck compared to the asset holdings.
Microscopic. BMNR is not an operational company in the traditional sense. It is an asset manager that happens to own a small mining division to generate some cash.
But despite that confusing income statement, the balance sheet, that's a different story.
The balance sheet is a fortress. There is no other way to describe it.
First, solvency.
They have effectively zero interest-bearing debt. That is a massive safety net. The crypto miners that went bust in the last cycle were the ones loaded up with debt. BMNR completely avoided that trap.
And liquidity looks extreme. A current ratio of 18.87.
It means they have almost $19 in cash and liquid crypto for every $1 of short-term bills they have to pay. Near-term bankruptcy risk is basically non-existent.
But again, this fortress was built on the back of that massive dilution.
The 19,000% increase in shares. The math is simple. The asset has to keep outrunning the dilution for the strategy to work.
So, given all this, we have to throw out PE ratios and just focus on one thing.
The net asset value, the NAV model. It's the only way to find the intrinsic value here.
So let's run the numbers.
Okay, first the asset value, 3.73 million ETH tokens. Let's use a conservative price of $3,000 per token. That gives us $11.19 billion.
Then you add in their cash and other liquid assets.
Right. They have about $882 million in cash and that $36 million moonshot stake. So we'll call it $0.92 billion in cash and equities.
Which gives us a total net asset value of $12.11 billion.
And the market cap right now is $12.26 billion. So when you do the math, it comes out to 1.01 times NAV. Parity.
Parity. And this is the whole point of our discussion today. This is the margin of safety.
You are getting the assets at cost. But it begs the question we raised earlier.
Right.
Why is the market withholding the premium?
Exactly. Why does the MicroStrategy Bitcoin trade at 2x its NAV, while the MicroStrategy of Ethereum is stuck at 1x?
Well, a few reasons. First, track record. MSTR has been doing this for years under a very well-known leader, Michael Saylor. The BMNR strategy is newer, and the management team is still proving itself in this new asset manager role.
So it's a show-me story.
It's a show-me story. And second, the entire upside catalyst, Memavan, hasn't even launched yet. That $300 million revenue stream, it's still hypothetical. The market is waiting for them to prove they can execute.
And until they get that proof, the fact that we're buying at cost, that's the opportunity.
That is the opportunity. If BMNR just gets that same 2x premium as MSTR, even if ETH's price goes nowhere, the stock could double to over $64 a share. That's the powerful upside here.
Part 2, chapters 4 to 7, market sentiment, ownership, risk, and final conclusion.
Chapter 4, market sentiment.
Okay, moving on. How is the smart money Wall Street looking at BMNR right now, especially with this valuation at parity?
Sentiment is, I would say, cautiously bullish. And the analyst targets are very clear. They believe that NAV premium thesis is going to play out.
What are the numbers?
The consensus price target is $53.50, with some analysts going as high as $60.
So from today's price of around $32, that's projecting, what, a 67 to 88% upside?
A huge upside. Wall Street is basically telling you they expect this stock to trade well above parity once Evan gets going, and the market environment is right.
And the media narrative reflects this.
The media is all about the scale. Every headline is world's largest ETH Treasury. It's being framed as a blue-chip crypto proxy. But, you also have to note the volatility. The sources talk about a 24% collapse in recent weeks. It's not a smooth ride.
Let's get into the technicals. As of today, December 3rd, what's the chart telling us?
Well, BMNR is trading just a bit below its 50-day moving average, which can be a bearish sign. But it does look like it's trying to find some support here.
In the longer-term trend?
The 200-day moving average is much higher, up at $38.80, so that tells you the stock is in a medium-term correction, but the bigger long-term bull trend is still intact.
What about momentum indicators, like the RSI?
The Relative Strength Index, the RSI, has been dipping into what traders call oversold territory, down in the high 30s. Often, not always, but often, that can signal that a bounce is coming.
And two last important metrics for institutions: short interest and liquidity.
Short interest is really low, only 3.6% of the float. That means very few big players are willing to bet against the Tom Leith thesis right now.
They respect the potential upside too much.
They do. And the liquidity is fantastic. Over 60 million shares trade on an average day. That's critical because it means big institutions can get in and out of large positions without moving the price too much.
Chapter 5. Ownership structure.
The ownership structure is actually a huge point of validation for their strategy. This is not just a bunch of retail investors in a meme stock.
No, the cap table shows some very serious institutional money has bought in.
It does. Total institutional ownership is about 23.5%, and the names on that list show that BMNR has passed some very tough due diligence tests.
Who are the big players?
You've got the traditional finance giants like Morgan Stanley and BlackRock. Their presence is a huge stamp of approval on the compliance and governance side. Fidelity is in there as well.
And then you have the quant firms, right?
Right, like Susquehanna or SIG. They hold about 2.0%. When the quants show up, it means they see the stock as a liquid and efficient way to get exposure to the underlying asset.
And we can't forget ARK Invest, Kathy Wood's firm.
ARK has been aggressively buying the dip on this one. They clearly see BMNR as a core piece of infrastructure for the future of the internet, which fits their whole thesis perfectly.
So you have this really diverse base of believers, from passive funds to quants to high-conviction thematic investors.
Which is exactly what you want to see. It helps provide a floor for the stock price during downturns.
Now, what about the insiders? Ownership is almost 6%.
5.97%, which is healthy. It shows management has plenty of skin in the game. We've seen some small sales, probably for tax reasons, but the chairman has been very clear that their strategic guidance is to keep accumulating.
We have to remember, with that 19,000% dilution, their percentage of ownership has gone way down, even if their conviction hasn't.
That's the mathematical reality of their strategy, and it leads to the main risk on the cap table: concentration. If institutions own 23.5%,
That leaves about 75% in the hands of the public and retail investors.
which means the stock is going to be very sensitive to retail sentiment, to swings on social media. The institutions provide a base, but the retail majority is what makes the ride so wild.
Chapter 6, Risk Assessment.
Okay, we've laid out the huge upside case. Now we have to be disciplined and look at what could go wrong. Let's use a SWOT framework here to synthesize the risks.
All right, let's start with the internal factors. Strengths.
The strengths are all about resilience. The fortress balance sheet, zero debt, over $800 million in cash, the low-cost leadership from that Trinidad power contract, and, of course, the insurmountable Treasury scale.
And weaknesses.
The weaknesses are the flip side of their strategy. The dilution addiction, they are completely reliant on issuing new shares to grow, and the microscopic operational revenue makes them entirely dependent on the price of ETH. There's no operational buffer.
Okay, now for the external factors. Opportunities.
The opportunities are massive. Mavan is number one. That potential $300 million plus recurring revenue stream is a game changer. And number two is the Fusaka supercycle. If this upgrade really works, they benefit more than almost anyone.
Now for the threats. Let's really dig into the three big ones that could just derail this whole thing. Threat number one.
Yeah.
The tariff shock.
This is a geopolitical risk. The new U.S. administration has been talking about aggressive tariffs on Chinese imports, maybe 25% or more.
And that's a problem because all the mining hardware, the ASICs, are made in China.
Virtually all of them. A tariff like that would make it dramatically more expensive to buy new machines for their U.S. operations. It could easily wipe out 10–15% of their mining margin in Texas, maybe even force them to stop expanding there altogether.
So their U.S. mining arm could become a stranded asset.
Potentially. Now, threat two is protocol risk. And this is so relevant because the Fusaka upgrade is happening today.
This is the risk of betting the entire company on one single piece of technology.
It's the existential risk. If there's a critical bug in this upgrade, if there's a big slashing event, if the network splits, the value of their 3.73 million ETH could get crushed overnight. They have no diversification against the failure of the Ethereum protocol itself.
And threat three is the one that could kill their future growth, the regulatory hammer.
Specifically aimed at Minvan. Their whole growth story depends on being able to stake their ETH and earn yield.
But what if the SEC decides that corporate staking is an unregistered securities offering?
It would be catastrophic. They could face fines, be forced to completely restructure Mavan, or in a worst-case scenario, just be shut down entirely.
And that would kill the very thing that's supposed to earn them that valuation premium.
It would vaporize the bull thesis overnight. Regulatory clarity is everything for Mavan's success.
Chapter 7. Conclusion.
So we've reached the end, the final synthesis. And BMNR really is the ultimate paradox. If you look at it through a traditional PE lens, it's absurdly overvalued.
But if you look at it based on its intrinsic asset value, the case becomes incredibly compelling.
Let's sum up the bull case, the Alchemy realized. It's simple. Today, you can buy $1 worth of Ethereum for $1.
And for free, you get a management team dedicated to growing that pile, and you get a call option on the Mben staking business.
A call option that could turn this into a stable, yield-generating stock with a 3–4% dividend in a couple of years. And if ETH hits, say, $10,000 by 2030, this becomes a $40 billion company. That's the leverage.
But the bear case, the dilution trap, is just as powerful. It argues this is just a closed-end fund that survives by diluting its owners.
And if ETH drops back to $1,500, that tiny mining operation can't possibly support the valuation. And that's staking revenue. It's completely hypothetical until 2026, and it could be killed by a regulator at any moment.
So what's the final outlook based on everything we've seen?
The conclusion has to be nuanced. Right now, today, BMNR is fairly valued relative to its net asset value. But the key finding is that the lack of a premium, the market's skepticism, is your margin of safety.
You're paying for the assets, not the execution risk.
Precisely. So if you're an investor who wants leveraged, managed, easy exposure to Ethereum without dealing with your own crypto custody, BMNR is a buy.
But if you're a pure value investor who needs operational cash flow today and a big discount to book,
then it's a hold. You wait until Maven is launched and proven. The success of the Fusaka upgrade today and the successful launch of Maven in Q1 2026, those are the two catalysts that will decide if this stock earns its premium.
And here's a provocative final thought for you to explore after we're done.
We talk a lot about that Trinidad power contract, the one at 3.035 cent per kilowatt.
Right, half the U.S. average. A huge moat.
We've been looking at it as a strength for their own mining. But what if it's actually an unlisted hidden asset? Could they sell that power contract or that entire Trinidad facility for a massive premium to a competitor who's only focused on hash rate?
And use that cash to fuel the Treasury without any more dilution.
Exactly. A clean cash influx. It's a really fascinating angle to think about.
Selling one moat to fund the bigger one. We love these deep dives.
Like and subscribe to Stock Analytics AI.
For $4.99 a month, get 500+ deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next. Plus, members-only requested deep dives.
And as always, remember that this deep dive is based on intensive AI-driven research protocols.
This report is for informational purposes only and does not constitute financial advice. All investments involve risk of loss. We'll see you on the next deep dive.